In this video, we want to show you some information about how the Earned Income Credit, one of the most popular tax credits, interacts with self-employment income. So let's say that somebody is an independent contractor or has their own small business. They may also be eligible for the Earned Income Credit. However, unlike wage earners who have a set amount on their W-2, a set number, the business owner has some ability to take deductions or adjust the income from the business. And this adjustment of the income can actually affect the Earned Income Credit amount that the taxpayer can receive quite a bit. So I just want to show you guys quickly how that kind of thing would work and some of the considerations involved. So let's say in this case we have a single taxpayer and self-employed, okay, 12,000 gross income, and then taking some deductions against that income. So deduction on Schedule C is any expense that's ordinary and necessary to the production of the income of the business. So in this case, this taxpayer has claimed some deductions in order to reduce the net profit on Schedule C. Okay, and we can see how this works on the tax return. The total income, gross income, was 12,000, remember, but then the deductions reduced the net figure to 4,000. Now, it's very important to realize that this 4,000, the net profit from the business, is what is used to calculate the Earned Income Credit. Okay, because remember, the Earned Income Credit is based on the income of the taxpayer. So in this case, the Earned Income Credit for $4,010 in business income, Schedule C income, the Earned Income Credit is $285. The Earned Income Credit, in essence, let me get out of this. This is another video that we're doing here. The Earned Income Credit, in essence, pays part of the self-employment tax. So see how this pays that, and the taxpayer has a balance like that, okay? What you have to keep in mind, though, with Schedule C is that this, you don't have to take all of these deductions if you don't want to. And in some cases, that would decrease the Earned Income Credit. So let's see for this person, for this taxpayer, if removing one of these deductions might increase the Earned Income Credit. Okay, so now you're leaving a little bit more profit from the business. Okay, the self-employment tax went up. The Earned Income Credit also went up, though. So the Earned Income Credit went up, but the tax went up. The taxpayer still owes a balance, a larger balance than the taxpayer was owing. So they're not saving money by doing this, but there is more self-employment tax being paid, and more of that tax is being paid by the Earned Income Credit. So in a way, the taxpayer is receiving some credits at Social Security based on this increased Earned Income Credit. Now, one thing you would want to do when you're looking at this kind of thing is look at the actual Earned Income Credit tables, okay, which are found in publication 596. And you can see how these tables work. They're a little tricky at first to read, but you get the hang pretty quick. This is the amount of the earned income. Okay, this is the filing status up here: single head of household or qualifying widower, and then married filing jointly has its own separate. And then the number of children. So no children, one child, two children. And what you can do is you would match up the earned income amount. So let's say in this case it was 6,000 something, right? So you can see this 464. That's the maximum Earned Income Credit for a single person. Okay, now when this really comes into play is if there's a dependent. So let's add on a dependent and see how that kind of changes things. So child, okay, dependent, let's make them about 10 years old. Okay, I have to have a social to be eligible for Earned Income Credit. So let's just set this up and see how it would work. Okay, so you can see adding on a dependent definitely increases this Earned Income Credit quite a bit, right? And you can see how in the tables that's reflected. So 464 and now one child. So in this column, now it's at 2,083. So it's definitely increased the earned income credit. What you want to see now too, though, okay, now there's a refund, 1782. What if the taxpayer decided to not take another deduction? Okay, let's say that taxpayer didn't take this $2,500 deduction or this $500. Okay, so you're not required to always take all your deductions. In this case, showing more business income now. And look, you can see how the earned income credit has gone up, so 3,069. And you can see that more of the child tax credit, the additional child tax credit, is refundable. So also more Social Security tax is being paid on behalf of the taxpayer. And best of all, there's a much bigger refund, so about $1,000 more refund, $2,780, and it's mainly because of that $1,000 increase in the earned income credit. And remember how the earned income credit is tied to the income. So by not taking those deductions on Schedule C, the taxpayer actually gets a larger refund, which is something that you wouldn't expect. It's kind of counterintuitive, but because of the way the earned income credit works, it does happen. So let's say moving up here, we were around this amount of income now, and you can see the earned income credit has increased. Okay, so this is the max earned income credit with one child. And you can see with 2 children here, 3 children, the numbers can change. So this is something that, as a tax preparer, you definitely want to keep in mind when you're working with self-employed taxpayers, especially when those taxpayers have children who might be eligible for earned income credit. All right, so that's a tip of the day, and thanks a lot for watching our video. Make sure to check out our classes online. ProntoTaxClass.com is a good place to start on that. All right, thanks a lot, you guys. Have a good day.